Welcome back. It's commodities time now on Business Morning, and we're doing that with Dr. Adesola Somoni, is the senior analyst with Financial Derivatives Company, joins us virtually from Reading in the United Kingdom. Thank you so much for your time this morning, Dr. Adesola. Well, we'll start with Brent. It's up this morning. We saw prices surging, and we know it has to do with drawdown in United States inventories and some of those stockpiles. Could you give us the details of this?
Thank you for that question, Ina. Thank you for having me on the show today. So let's start by saying that the global oil market is currently a tight market, and that's mainly due to large production cuts by OPEC Plus, in particular Saudi Arabia and Russia. We know Saudi Arabia cut production by more than their fair share, by around 1 million barrels a day, and they're expected to hold that up until the end of the year. Russia also cut production by around 300,000 barrels a day. In addition to that, they banned the exports of gasoline and diesel, which further tightened the market. And one of the direct impacts of this is a drawdown in crude stock inventories in the United States. Data from the Energy Information Administration showed that there was a larger than expected drawdown in U.S. crude stock inventories by around 2.2 million barrels against forecasts for a moderate drawdown of around 300,000 barrels. The week before also, we saw the large drawdowns also of about 2.1 million barrels. In addition to all of this, we are seeing in China, globally, we are seeing a stronger demand for oil globally. Also in China, despite the lackluster economic performance in China, we also seen some oil demand coming out of China. The expectations that towards the end of the year, the market will be undersupplied by around 1.8 million barrels a day, which suggests that oil prices are likely to remain elevated in the near to medium term.
And then the outlook for oil remains bullish. We saw JP Morgan saying that it's going to hit $150. That'll be good news for countries like Nigeria.
Indeed, JP Morgan are notoriously bullish on commodities, particularly oil. So it's not surprising that they see oil reach $150 next year. Also, the forecast for average oil price for this year has now been increased to around $91 per barrel against $81 per barrel that it was before. And obviously, higher oil prices is good news for oil exporters like Saudi Arabia, Russia, Nigeria. But on the other hand, it has big implications for oil importers. Because as oil prices in the global market continue to trend upwards, it also then translates into energy prices in the domestic economies for oil importers, which also has implications for inflation. And it's important to note that, even though globally inflation is trending downwards, it's not really where we would like it to be. And, the central banks globally are keeping a keen eye on inflation. And if, the inflation comes in stronger than expected, then we might see this tightening cycle stay on longer.
And then talking about gas, we see that Europe is increasing its demand. I thought their reserve was about 90% full about a month ago.
Indeed. So for the European gas market, there are a couple of things that you need to know. Number one is they're trying to win off Russian gas. We all know that. Number two, like you mentioned, is that their storage is actually around 94% full. But that notwithstanding, Europe is still trying to, secure import sources just to prevent a potential energy crisis. I mean, last year we were able to prevent that due to a warmer than expected winter. And that is why, because, Europe is still trying to secure import sources, that is why any threat, whether it is a perceived or realized threat to global oil supplies, it makes the European gas market quite nervous. For example, over the past couple of weeks, we saw in Australia threats of a strike in some of the gas exporting ports, and that really shook natural gas prices in Europe. Thankfully, last week the labor dispute was resolved, so that threat did not materialize. Also, in the United States, which is one of the biggest supplier of gas to Europe, there were some there was some issues in some export terminals, in some of the largest export terminals in the US, which also threatened threatened natural gas prices in Europe. But generally, I think that the stock is solid, is robust, and I think whatever volatility we see in prices would eventually convert towards a lower steady state.
And then cocoa, the demand is weakening. Do we know why?
So essentially, what's happening in cocoa markets is kind of like a correction. There are two main factors driving cocoa prices at the moment. Number one is technical factors. Just yesterday we saw bad performance, or we saw bad performance in the S&P 500 market, which brought about some risk-averse sentiments in the commodities market, and that led to sell-offs in cocoa futures. We're also seeing a stronger US dollar. The US dollar has risen to, I think, a 9-month high, which is reducing the demand for dollar-denominated commodities like cocoa. However, when you look at fundamentally, the stock of cocoa is actually declining. If you look at production and exports from the largest producers in West Africa, which account for around 45% of total production, you see that diseases such as black pod diseases, swollen shoot disease, all of these are constraining production and output in Ivory Coast, in Ghana, in Nigeria, and that has happened for a while. So prices in cocoa market has been elevated for a while, and it's kind of causing some form of demand correction, and that is why we are seeing some form of lackluster demand for cocoa. But when you look at the stock of cocoa globally, it's quite low because of these production challenges coming out of the biggest producers in West Africa.
All right, and looking inwards now, our domestic, what's happening to our domestic crops and commodities?
For our domestic commodities market, let's divide the commodities into two: the local commodities and the imported commodities. For the imported commodities, due to the FX pressures, we are seeing prices trend upwards. If you look at the price of flour, for example, it's trending. It's up around 8.6% to around 38,000 naira. If you look at the price of rice, is also a bag of rice, a 50 kg bag of rice, is also up 9% to around 60,000 naira. But when you look at the commodities that are produced domestically, also that coincides with the harvest season. We are seeing more supply for some of these commodities, that prices are trending downwards. For example, if you look at the price of tomatoes, it's down around 38% to 40,000. Now that is a 50 kg basket of tomatoes. If you look at the price of peppers, they're also down around 12.5% month on month to around 35,000 naira. And if you look at the price of a basket of onions, a 50 kg basket of onions, they're also down around 18% to 45,000 naira, mainly due to the harvest season, which usually increases the supply of these commodities.
Yeah, I do wish we could, capture all of that so that it wouldn't be after the harvest season, then prices, surge again. If we have storage and preservation facilities, that would sustain these things in very good condition. Well, thank you so much for sharing your perspective with us this morning, Dr. Adesola Somoni, Senior Analyst, Financial Derivatives Company, for your time this morning.
Thank you for having me.
Let's take a breather. We'll be back for more markets.